Hi guys, welcome to my channel. And today we're gonna be talking about FAC 1503. So currently the current structure, UNISA had subdivided the learning units from, I think it's 1 up to 8. So I'll be trying to go on a journey with you from the first learning unit to the 8th learning unit, just going through it and making sure that I try and explain what I can, where I can, just to give you an extra edge and an extra advantage. Thank you so much for subscribing. Thank you so much for liking this video. If you haven't, please do like, please do subscribe, and please do drop a comment. Please do drop a comment. I really appreciate feedback from you, especially towards the videos that will be done and the content that is covered. I really appreciate the feedback. And also, unfortunately, I cannot drop the pages or the copies or parts of the UNISA learning material because of copyright reasons. I don't want to attract any copyright, so if I dare do post a picture, it will be an infringement, because the study unit or the learning unit PDFs, those are property of UNISA. So circulation and everything, I'm sure, is prohibited and all of that, and you have to get proper, what do you call it, you have to do it via proper channels in order for you to not offend or not to get in trouble with a lot of people. And the goal of this is not to get in trouble with a lot of people, but to help as much as I can where I can. So I would want to advise you, if you're here, it would be very much beneficial for you to take your study guide or the copy of your learning unit, the recent one. If you do not have that one, you can always get a copy at Telegram. Go to Telegram groups, and I'm sure there under files you should be able to come across the material that you're going to be using. So without wasting much of your time, let's get right into it. So the first learning unit is going to be talking about is the nature, function of accounting, financial accounting principles for law practitioners. So the first chapter, they are talking about the nature and the function of accounting. So by definition, what is accounting? So you just have to go and do a study there. I think it's the first thing, the first paragraph on an introduction of what is accounting. It was really given in detail. I don't need to go any further there. They really did justice to it. The major thing that you have to also just take note of are the processes involved, right? So the processes involved in accounting mainly entail you have to identify the events where there's evidence of economic activity. What that means is identify the events where there's a transaction of money, where there's an exchange of money for something. That is basically what they mean by economic activity, where there is an exchange of money. Then the second part you have to record. It is very key. Those are very key fundamentals. You identify the transaction where people are exchanging money. The next part stop, you have to record the transaction, right? Then after recording the transaction, the next bus stop, you have to communicate what you'd have recorded. So it doesn't just end with you doing your books and you writing it down nicely. You should put it in a way that you can communicate that message to someone who might have limited to no experience in accounting. So you should be able to do it to the benefit of someone who might have none, limited to no experience whatsoever in accounting. They go on to talk about the nature of accounting. The nature of accounting is like what it entails. So basically that's your theory. It's not really something that is hectic that will need me to explain. Forms of ownership that they talk about there. They have a sole prop, they have partnership, close cooperation, and companies. For the purposes of a module, you just have to be on a need-know basis. You don't have to go into detail in knowing, okay, what is a sole proprietor, what is a partnership, what is a close cooperation, what are companies, and what do they entail, and a lot of things. You just have to know them. So remember, the last part that we talked about, it fundamentals, was the communication element. So you'll be communicating to people who would want to use this information. So the people who would want to use this information You have your investors, your creditors, your employees, government, and management. Just to give you a brief, the investors will want to know, okay, is the company doing well? If it's doing well, okay, we can increase funding, we can give them money. Or your creditors, sometimes when you do business, you don't always do business on cash basis. For instance, let's say you are a retailer, you have to go and buy stock from your suppliers. Sometimes those suppliers will want to come up with credit terms, which makes it easier for you. But in order for them to grant you credit, they need to see how you are performing financially, how your financials are looking, and if they're looking good, they'll give you. Government wants to find out how much they can tax you. Okay, how much they can take as taxation and a whole lot of things. So their taxation that they're going to be paid to them is going to be based on how much you are making. So for them to be able to assess how much you are making, they have to see your financial statement. So they become a user. The management will have to make decisions. It's mainly for decision making purposes. So that is that part about management. So they use the financial statements for decision making purposes. Again, on this page, you need to know them. You need to know the users. You don't really need to get in depth with them. So the users are then split into two categories. Internally, it's in-house. Basically, that's what it means. Inside the firm, the people who are going to be using the financials inside the firm. So your management is inside the firm. Your employees are going to be found inside the firm. So that is not going to be too problematic for you. The external users, anyone outside of your firm becomes an external user. So whom are you going to find outside? You're going to find investors who are going to be outside of your firm. You're going to find creditors who are going to be outside of your firm. You're going to find government. It's also going to be outside your firm. So there are various forms of accounting, financial accounting, management accounting, blah blah blah, and they concentrate on what do you call it? We are going to be concentrating on financial accounting going onwards. So they then come across there's a nice way that they come across there that they put out for you, which is your internal control. So what is an internal control? An internal control is just measures which are put in place to limit risk. Okay, so internal control, these are measures, steps which are put in place to limit risk. I know they have a paragraph that they've given you there. You can go and read it for yourself for further understanding. But for you to just get it quickly, your internal controls are measures which are put in place to reduce risk. So what are those measures which are put in place? So we can have such measures as built-in controls, which are built-in, which means they are already inherent, which means they are already within a system, right? Measures which limit risks. I always give an easy example for you to understand internal control. When you go to campus on UNISA, there are certain parts that you can access straight without anything, right? And then there are certain parts of the campus that you need a student card in order to access. So there's the general side where anyone, any member of public can just get inside. But there's also sections where you need your student card in order for you to access. So those areas that you need a student card, that requirement for the student card becomes an internal control. That's what they basically mean. So they are limiting, let's say, library access. For you to get into the library, you need a student card. So they don't want just the general public to benefit from the library. They just want UNISA students. Hence, you need your student card. So what internal control will be found there? That machine which requires you to put your card becomes an internal control. Okay, so there are controls which are going to be built in, which are given here. Numbered source documents, dates on source documents, control accounts, separate bank accounts, keeping petty cash, non-current asset register. So you have to know all of these. I think on a need-to-know basis for the purposes of your assessments, you have to know the built-in control measures which you're going to find at an organization. So your questions mainly they are on a true or false basis. So you have to know the list before you can give people true or false answers. So it's an important page to mark for yourself so that you can go through them thoroughly, because your lecturers, they enjoy asking and testing you guys regarding your internal control measures as well. So they're going to talk about internal control systems, right? Internal control systems, we now have, what do you call it? We now have your efficient banking for all cash received, all payments made by EFT and all of this. I'm sure you've come across places where they say we don't take cash. You know, it's an example of an internal control system. They are trying to limit risk. So all the measures, if you can read all these sub bulletins that they put out for you, if you can read all of them, they are measures to limit risk. In an organization, in any organization, there's always a certain risk that is going to be there. There's a risk that something might go wrong. Remember, what does the risk mean? I'm throwing this word around in case you just want like the full definition. Risk simply means susceptibility to danger, or the potential or probability that there can be danger. It's not danger itself, but it's possible that there might be danger. For instance, if you are going to be at your firm and everyone operates, everyone can make payments or can make it receive payments, right? There's going to be a danger that the money might go missing if you don't have like proper channels which like guard the money that you have as a firm. There's a danger that that money can go missing. If you are at an organization where everyone knows the code to the safe, there's a danger. It might not happen, you might not get robbed, but there's a danger. That the danger would now be that someone might one day decide to come and steal. You know, so a risk is always going to be the possibility or the probability of danger happening. You can drive without a seatbelt, and you can even get to where you're going without a seatbelt. But there's a danger that if you are to encounter an accident, you see. So in business, people do plan. When they're doing their planning, they also have this thing where they're actually trying to analyze, okay, where is the areas of weakness in a business where we might be hit. So when we analyze and assess and get those areas in the business where we might be hit, we then come up with internal controls to reduce that risk. That is basically what they are talking about here at internal control. So the next part of that they'll be talking about there is your financial frameworks. So your financial frameworks, they are like your standard, your IFRS and what have you. So for you to understand this, I think the standard door height is 2 meters, right? So most of the doors that you're going to come across, a door is going to be 2 meters, right? So meaning when a house is built, there is a frame which is put on where you can then place the door which is going to fit. So when people are making those frames, they make them for 2 meters because they know the door is going to come and it's going to be 2 meters long. The reason why we have frameworks in accounting, we have them so that firm A, firm B, firm C is going to be accounting on a same basis. Meaning the accounting that I have here versus the accounting that someone has there is going to be the same, mainly because we are using the same framework. So the framework that is used for financial accounting is IFRS, which is your IFRS, your International Financial Reporting Standard, which is known as IFRS, or the IFRS for SMEs. But you just have to know the acronym IFRS. For the purposes of this module, you will need to know the part or that acronym, the International Financial Reporting Standard. For the purposes, you have to know that okay, that is the frame, that is the guide. Those are the people who tell us, okay, you debit this, you credit this, you debit this, you credit this, you debit this, you credit this, so that we are all talking the same language. Because imagine I'm debiting this when you are crediting this, and I'm debiting, we're creating a problem and no one is going to understand what is going on in those books at all. So remember, for this to be beneficial to you, have your study guide, pause the recording, fetch your study guide, and follow me as I will be just guiding you through your study guide. They talk about another interesting chapter, another interesting topic, which is the conceptual framework, which are the rules and what have you. So yeah, it's really a boring thing, but you have to just go and read as if you're reading a novel so that you know, okay, where did these accounting standards come from and where these statements coming from. So for testing wise, they want to test you on those acronyms, right? So we have the SAICA, which is the South African Institute of Chartered Accountants. We have the International Accounting Standards, IAS. We have the International Accounting Standards Board, which is the IASB. So you just have to know those acronyms, what they stand for. You don't have to like get into detail with them. It's too much for you, but for your standard, that's all that you just have to know. Then there is another part, which is the fundamental principles. So you just have to know, okay, what are the principles which govern this? Remember, I'm just going to try explain, but you have to go and read again. If you don't understand, you can play back this video and try and get it, right? So the underlying assumptions that are in accordance to the framework, right? So what we assume is going on in the company according to the framework that we are setting. The first one is going concern. Going concern simply means we expect your business to still be functional for more than 12 months. That's all. So meaning when you are making your financial statements, you are making them in such a way that you have opening balances and closing balances, because you anticipate to be trading for a period of more than 12 months. That's what going concern comes up with. That's what going concern talks about mainly. Accrual basis, right? Accrual basis, they're saying the effect of transactions and events on a business must be included in the periods which those transactions occur. So what does that mean? That means even if you still remember, most people, when they were still not using prepaid electricity but are being built by the municipality would be like a month behind on their bills. So because they're a month behind on their bills, you will only pay probably at the time of this recording, let's say it's September, you only pay the bill for September in October, because you're going to get the bill for September around the middle of the month on October. But what accrual basis means is when you pay in October, you have to recognize the expense in September. Meaning you recognize an expense when it's incurred, not when it's paid for. I'll go again. Accrual basis simply says that you incur or you record a transaction, whether be it an expense, you record an expense when it is incurred, not when it's paid for. Or you recognize income when it's earned, not when received. That's what they try to say in that paragraph. For instance, if you are paid on the 30th, right, but you are paid up to the 27th, right, meaning the other days they'll be falling in the next month, right, you are only earning the money that you're going to on the 27th. You have already earned your salary, even though you're going to receive it on the 31st. That's what we mean. We have to understand each other here. Accrual basis simply says we recognize incomes when they have been earned, not received. You might perform a function or you might do a job now and the person is going to pay you next year. You don't recognize the income next year. You recognize it when you have earned the money, not next year. So accrual basis is an important function that you have to also understand. It will simplify your life, because I understand you're coming from a background where you'd think everything is happening on a cash basis. It's not. On accounting, it doesn't happen on a cash basis, because cash basis says the moment you receive money, you record the money. The moment you make the payment, you record the payment. But what happens when you don't receive the money and you've already done the job? Then what happens there? So in accounting, we then use what they call the accrual basis. It's not really so complicated. The other fundamental characteristics, you just have to know it. Relevance, your information has to be relevant. But faithful representation, if you say there's 1 million assets, we want 1 million assets. That's what faithful representation talks about. Materiality, please put things that are material to the financial statements in the financial statements. The nature, they're going to say in certain instances the nature of the information alone is insufficient to determine the relevance, blah, blah, blah. Right, so what the nature of the information that you're going to be putting there, it has to also match and be relevant to your financials. They also go on further with qualitative characteristics. As in completeness, make sure that everything for January is in January, everything for February is in February, everything for March is in March, and blah, blah, blah. That's what they're talking about with completeness. Neutrality, please, when you're doing accounting or bookkeeping or whatever that you'll be doing, you are doing it from a neutral point of perspective. You are not the one who's thinking you, so that when you communicate, your communication doesn't have a bias. So you have to be neutral, free from error, faithful representation of the information. Try to make sure that the information that you are going to present in financials is error free. So moving right along, right, so they're calling these ones qualitative characteristics. Remember, qualitative is ABC, quantitative they will be asking for calculations. So if you get a question just gonna be saying we want qualitative reasons, they want you to write down the reasons. So these are the qualitative characteristics of your accounting. Then we have the enhancing characteristics. They are there for you for further reading. It's not really complicated. Okay, it's not really complicated. We then go to the financial statements. So I need you there to be able to tell me, or to be at a place where you can know which statement stands for what. It is very important for you to know which statement stands for what, right? The statement of financial position is going to be reflecting your assets, liabilities, and equity, right, of a particular asset entity at a particular date. So financial position is our assets, liability. Profit or loss, right? Profit or loss, I want you to highlight yourself for that word performance. We want to see how the business performed. That is your profit or loss. Performance statement. It's mainly a performance statement, right? For a specific period. What you're going to find in your profit or loss is your incomes and expenses only. So there is no way other things which are not incomes and expenses are going to be in the profit or loss statement, right? Then we're going to have your statement of changes in equity. That is your capital, but for your purposes of your module now, don't really crack your head around it. Statement of cash flows, how cash is moving up and down the business. Not the financial statements, they are going to be given. You're going to have notes and a whole lot of things that are going to be happening there. Then to wrap up this chapter, they have the definition of things that I want to quickly go with you there so that you understand better, right? So they have the definition, they're looking for the definition of they give you the definition of an asset. So the key thing to understand on the definition of an asset is they are saying present economic resource, highlight that for yourself. Controlled, highlight that for yourself. As a result of past events, highlight that for yourself. And there is a potential to produce benefits, highlight that for yourself. There is reasons why I'm telling you just to highlight those keywords, right? It's a present economic resource today, meaning you already have it. So it cannot be an asset. A car that you want to buy tomorrow or a van that you want to buy tomorrow is not your asset because you don't have it today. So an asset, they're defining it as a present economic resource, right? You already have it in today. And because you have it, they also introduce another element called the control element, which is you can control it. For instance, say you're streaming on your laptop, you're streaming on your phone. You can decide to switch off your phone. You control the phone. You can switch it on the next day. You can switch off your laptop and never open it again. You control that laptop. So it becomes your asset because of the control element. And why are you controlling it? You are controlling it in the hope of producing future, right? You want to produce futuristic benefits. That is basically what they're talking about there. Then they go on to explain and they give you examples and wara. That is entirely up to you. Let's jump to liabilities. Liabilities, they are simply talking about debts, right? Debts. So I want you to take your highlight into the second sentence. They're talking about a present obligation, meaning the obligation is on today, right? The obligation is on today to transfer, highlight again, economic resource as a result of a past event. So I'll try and explain, but I need you to have highlighted that. A present obligation, then you have to highlight for me economic resource, you have to highlight for me past events. So basically what a liability stands for is we have you today needing to go and pay. You are obliged to go and pay MTN. You are obliged to go and pay Vodacom. You are obliged to go and pay Cell C. You are obliged to go and pay Telcom. Because yesterday you went into their store and you took an iPhone 13. So yesterday becomes the past event. And now economic resources, meaning you are going to part ways with money or something to a cash equivalent. You are going to part ways with economic event and you are obliged to do so. You are being obliged to do so because you did something in the past. I will make a video about assets, liabilities, and equity, but this is really in detail. If you go through this, it's really in detail and you won't struggle much to understand it. Owner's equity is what is left after you have taken after you've removed your assets from your, assets minus liabilities. What is left is your owner's equity, right? What is left is your owner's equity. It's very confusing. The definition of owner's equity is very confusing even for people who are doing accounting core. But for you to understand it, what you own, which is your asset, minus what you owe, which is your liability, what is left becomes your owner's equity. And they have that organogram of assets plus liabilities is equals to expenses. You can go there, you look at it, and it will be beneficial to you, right? Beneficial to you. They go on there to talk about incomes and expenses, right? So they're talking about incomes and expenses. Incomes and expenses are not so complicated to get. They're not so complicated to get, right? Incomes and expenses, the simple definition of an income, right? So the simple definition of an income is given as an increase in assets. So basically, if you do things that causes your assets to increase, that act is an income. Or if your liabilities decrease, if your liabilities are to decrease, it is also recognized as an income. Income is defined as an increase in asset or a decrease in liability as a result. That results in increases in equity. So the only thing that you have to be on the lookout for is the definition to be able to split the difference between a gain and revenue. Income is then split into two, revenue or gain. So if a retailer, like let's say ShopRite, if a retailer like ShopRite makes sales, people come and buy, people come and buy, people come and buy, the money they receive from people, it is part of sales, right? But if then ShopRite decides to sell one of their trucks, right? Remember, they are not in the trucking business. So because it's something outside of their ordinary activity, the profit that they make from selling their truck, probably because they are upgrading their fleet, it becomes a gain. So you should be able to split or to define, to give us the difference between revenue and gains. Gains, they are things that are outside of your ordinary business. Revenue, those are from ordinary business activities. So they have sales, fees, and everything that they have there for you. Blah, 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 continuing. Expenses, these are costs that you incur in you making money. Right, the costs that you incur in you making money. You open a firm, you want to represent as many people as you can so that you can make as much money as you can. So, but you still have to pay your interns, you still have to pay the accountant, you still have to whatever. So those are going to be expenses that you are going to come through or come across as you hope to be making the money. Then we have double entry, contra account. I've made videos specifically on those ones, your double entry and stuff. You can look up the channel. We are going to come across those videos. They're around 5 minutes long. They're not long. But up to where we are, this is the end of your learning unit. So the first learning unit is very intriguing. It's very interesting. Please take your time. Play the video in parts wherever I was explaining, and everything that I was explaining is very important because it's ABC. ABC questions require you to know what you are doing or what you are dealing with. So you really need to get in depth with it. Get in depth with it. And if you do not understand anything further, do holler at me. Do holler at me. I apologize. I cannot upload this copy that I'm using because it's property of UNISA. You want it, go to Telegram, and you can get into Telegram groups and download a copy for yourself. Play back listening to the copy, play back as many times as you can until you get to a point where you're satisfied. If you're still not satisfied, do let me know in the comment section, and let's continue learning. Remember to like, subscribe, share, and spread the word. And let's do this. Let's try and cover as much as we can in preparation for your assessments. Thank you so much for your time. Remember, like, subscribe, and do enjoy. Thank you.